You're scrolling through Zillow at 11 p.m. on a Tuesday night, looking at houses you can't quite afford and neighborhoods you're not sure you want to live in, and there's this gnawing feeling in your gut that you're either about to miss out on the opportunity of a lifetime or make the biggest financial mistake of your life. And here's the thing, both of those feelings might be right depending on what you do in the next 6 months. My name is Zach, and I spend way too much time thinking about real estate markets, interest rates, and why so many people buy houses for completely terrible reasons. If you're someone who's been saving for a down payment, watching home prices do absolutely insane things over the past few years, and you're wondering if 2026 is finally your year to pull the trigger, or if you're about to become the person who buys at the peak right before everything crashes, hit subscribe and give this video a thumbs up, because we're going to break down everything you need to know. Now look, I'm going to be completely honest with you. This is not going to be one of those videos where I tell you exactly what to do. Anyone who gives you a simple yes or no answer about whether you should buy real estate in 2026 is either lying to you or they're a real estate agent who gets paid when you buy. What I'm going to do instead is give you the framework, the numbers, the psychology, and the questions you need to ask yourself so that you can make the right decision for your specific situation. Because here's what most people don't realize. Whether 2026 is a good time to buy has almost nothing to do with 2026. It has everything to do with your personal finances, your timeline, your alternative options, and whether you're buying for the right reasons or the wrong reasons. And I promise you, most people are buying for the wrong reasons. Let me start with where we actually are right now, because you can't make a decision about the future without understanding the present. As of mid-January 2026, mortgage rates are sitting around 5.87% to 6.06% for a 30-year fixed mortgage, according to the latest data from Freddie Mac and Zillow. That's actually the lowest we've seen in over 3 years. If you were paying attention to the real estate market in 2020 and 2021, you remember that rates were down at like 2.5% to 3%. And your brain is probably doing this thing where it's saying, well, I should just wait until rates come back down to that level. Here's the thing, that's probably not going to happen anytime soon. The Federal Reserve has cut rates 3 times in late 2025, bringing the federal funds rate down to a range of 3.5% to 3.75%. But here's what you need to understand. The Fed projects only one additional rate cut in 2026. That means mortgage rates are likely going to stay in this 6% range for the foreseeable future. And honestly, from a historical perspective, that's actually pretty normal. Like if you look at mortgage rates from the 1970s through the 2000s, rates averaged well above 7%. Those pandemic-era rates at 2.5% to 3%, those were the anomaly. Those were the weird thing, not what we're experiencing now. But here's where it gets interesting. Even though rates are nowhere near those pandemic lows, they've actually dropped significantly from where they were just a year ago. In January 2025, rates were sitting above 7%. Now they're around 6%. That's a full percentage point lower, which translates to real savings on your monthly payment.
Now, let's talk about home prices, because this is where things get complicated. According to recent data, the median home price in the U.S. is hovering around $410,000 to $428,000, depending on which data source you look at. Redfin has it at $428,346 as of December 2025. That's actually only up about 0.4% from the previous year, which means prices have basically stabilized after the insane run-up we saw from 2020 to 2022. So you've got this situation where rates have come down from their peak but are still elevated compared to a few years ago, and prices have basically flatlined. Let me give you some actual numbers to make this real. Let's say you're buying that median-priced home at $425,000 with a 20% down payment, which is $85,000. Your loan amount is $340,000. At a 3% interest rate, which is what you could have gotten in 2021, your monthly payment would be about $1,434. At a 6% interest rate, which is closer to where we are now, that same loan costs you $2,039 per month. That's an extra $605 every single month, or $7,260 per year. Over 30 years, you're paying an additional $217,800 in interest alone. Now, you might be thinking, okay, Zach, this is depressing. You're basically telling me I should have bought in 2021 and now I'm screwed. And look, I get it. But here's what you need to understand. You can't make financial decisions based on what you should have done in the past. You can only make decisions based on what's in front of you right now. And what's in front of you right now is actually a market that's becoming more favorable to buyers. Here's what I mean. According to Redfin's latest data, only 22% of homes sold above list price in December 2025, which is down from 24.2% the year before. The median days on market is now 60 days, up from 54 days a year ago. Inventory is up 4.4% year over year. The feeding frenzy, where people were waiving inspections and offering $50,000 over asking price, that's mostly over. Sellers are having to be more realistic about pricing. This is where the psychology comes in, because buying a home is not just a financial decision, it's an emotional one. And I think one of the biggest mistakes people make is they let their emotions override the math. They feel like they're throwing away money on rent. They feel like they're missing out because their friends are buying houses. They feel like home prices are just going to keep going up forever, and if they don't buy now, they'll be priced out forever. Let me address each of these because they're all based on flawed thinking. First, the idea that you're throwing away money on rent. This is probably the most common piece of terrible financial advice that gets passed around. Here's the reality. When you rent, yes, you're paying for housing and you're not building equity. But when you own, you're also throwing away money on interest, property taxes, insurance, maintenance, and opportunity cost. In that example I gave you earlier with the 6% mortgage, in your first year of payments, you're paying about $20,000 in interest alone. That's money you're never getting back. That's money you're throwing away to the bank. Now look, I'm not saying renting is always better than buying. What I'm saying is this idea that rent is wasted money and mortgage payments are not is just mathematically incorrect. The question you should be asking is, given my specific situation, am I better off renting and investing the difference, or am I better off buying and building equity through appreciation and principal paydown? Second, the fear of missing out because home prices might keep going up. This is where we need to talk about what actually drives home prices. Home prices are determined by supply and demand, but also by affordability, and affordability is largely determined by interest rates and incomes. Right now, prices are up only 0.4% year over year, which is basically nothing. That's not the 10 to 20% annual increases we saw in 2021 and 2022. The market is cooled significantly. Some markets are going to see appreciation. Some markets are going to see prices stay flat or even decline. The idea that real estate always goes up is based on looking at very long time horizons, like 20 or 30 years. In the short term, real estate can absolutely go down. Just ask anyone who bought in 2006 and tried to sell in 2010. Third, and this is the big one, you need to be honest about why you want to buy. If you're buying because you found a place you love, you plan to stay there for at least 7 to 10 years, you can comfortably afford the payment, and home ownership aligns with your lifestyle, great, that's a good reason to buy. If you're buying because you feel pressure from family, or because you think it's what adults do, or because you're trying to time the market, or because you're afraid of missing out, those are bad reasons to buy. Now let's talk about rental properties specifically, because that's a whole different calculation. The question of whether 2026 is a good time to buy a rental property entirely depends on whether you can make the numbers work. And here's what most people don't realize. It's really hard to make the numbers work right now in most markets. Let's run through an example. Say you're looking at a rental property that costs $350,000. You're going to put 25% down. Most lenders require more down for investment properties, so that's $87,500. Your loan is $262,500 at, let's say, 7%, because investment property rates are typically higher than primary residence rates. Your monthly payment is about $1,746. Now, you've also got property taxes, which let's say are $4,000 a year or $333 per month. Insurance is probably $1,200 a year or $100 per month. You should be budgeting for maintenance and repairs. A good rule of thumb is 1% of the property value per year, so that's $3,500 per year or $292 per month. You might have HOA fees, you've got vacancy costs. Even if you have great tenants, you're going to have turnover. And you've got property management if you don't want to deal with tenants yourself, which is typically 8 to 10% of rent. Add all that up, and your total monthly costs are probably around $2,600 to $2,800. To get a positive cash flow, you'd need to charge at least $2,900 to $3,100 per month. And here's the thing, in a lot of markets right now, a $350,000 house doesn't rent for $3,000 per month. It rents for $2,200 or $2,500, which means you're losing $400 to $600 per month out of pocket. Now, some people will tell you that's okay because you're getting appreciation and you're getting principal paydown and you're getting tax benefits, and all of that is true. But if you're consistently losing money every month, you need to have a very clear strategy for how long you can sustain those losses and what your exit plan is. The rental property market in 2026 is really going to depend on your specific market. There are some markets where you can still find properties that cash flow. They're typically not the sexy markets. They're not Miami or Austin or Denver. They're places like parts of the Midwest where prices are lower relative to rents. But those markets come with their own challenges, like potentially higher crime, lower appreciation, and harder to manage properties if you don't live there. Here's what you need to do if you're seriously considering buying either a primary residence or a rental property in 2026. First, get your personal finances in order, and I mean really in order. You should have zero high-interest debt. You should have a fully funded emergency fund. I'm talking 6 months of expenses at a minimum. You should have your down payment saved, plus another cushion for closing costs and unexpected expenses. Second, run the actual numbers for your specific situation. Don't use rules of thumb, don't use what your real estate agent tells you. Sit down with a spreadsheet and calculate your actual monthly payment, including taxes, insurance, and maintenance. Compare that to what you're paying in rent. Factor in opportunity cost. If you invest that down payment instead, what kind of returns could you expect? Be conservative with your assumptions. Third, think about your timeline. Real estate is not a get-rich-quick scheme. It's a long-term wealth-building tool. If you're not planning to stay in the property for at least 7 to 10 years, you're probably better off renting because the transaction costs of buying and selling, realtor commissions, closing costs, moving expenses, eat up any gains you might make. Fourth, get pre-approved for a mortgage, but don't maximize what the bank will give you. Just because you're approved for a $500,000 mortgage doesn't mean you should take it. The bank is optimizing for their profit, not your financial security. A good rule of thumb is that your total housing costs, mortgage, taxes, and insurance should not exceed 25 to 30% of your gross income. And honestly, I'd aim for the lower end of that range.
Fifth, be patient and strategic. The advantage you have in this market is that you're not competing with 20 other offers. You have time to find the right property, do proper inspections, negotiate on price, ask for seller concessions. Don't fall in love with a house before you've done your due diligence. There will always be another house. Now, let me give you some specific scenarios where buying in 2026 might make sense and some where it probably doesn't. Buying makes sense if you're planning to stay in the same location for at least 7 to 10 years. You have a stable income and emergency fund. You found a property you can comfortably afford, and I mean comfortably, not stretched. You're in a market where prices have stabilized. You can get a rate in that 5.5% to 6.5% range based on your credit score. And most importantly, home ownership aligns with your lifestyle and values. Buying probably doesn't make sense if you're not sure where you'll be in 5 years, you're stretching your budget to afford the payment, you're buying primarily as an investment and the numbers don't cash flow, you're in a market that seems overheated, or you're buying because of fear of missing out or social pressure.
For rental properties specifically, it makes sense if you can find a property that cash flows from day one, or you have enough reserves to cover negative cash flow for an extended period. You understand landlording and are prepared for the reality of managing tenants. You're investing in a market you understand well, and you're looking at this as a long-term hold, at least 10 to 15 years. Here's the bottom line. 2026 is not universally a good time or a bad time to buy real estate. It depends entirely on your situation. What I can tell you is that the market is more favorable to buyers than it's been in several years. Rates are down from their 2023 and early 2024 peaks. You have more inventory to choose from. You have more negotiating power. Sellers are being more realistic. But that doesn't mean you should rush into anything. The pressure you feel to buy right now, most of that is psychological, not financial. The real estate market will still be here in 6 months. It'll be here in a year. There's no finish line you're racing toward. What I want you to do is take a step back and think about what you actually want from home ownership. Is it stability? Is it the ability to customize your space? Is it building long-term wealth? Because all of those are valid reasons. But if you're buying because you feel like you should, or because you're afraid of missing out, or because you think it's automatically the best financial decision, pause, run the numbers, be honest with yourself. Because here's what I've learned from spending way too much time thinking about this stuff. The best time to buy real estate is when it makes sense for your specific situation, not when the market is at some theoretical perfect moment. The people who build wealth through real estate are the ones who buy properties they can afford, hold them for a long time, and don't panic during market fluctuations. If you do decide to buy in 2026, go in with your eyes open. Understand that rates might go down further over the next year or two. The Fed has indicated they'll likely cut once or twice more, which could bring mortgage rates down another 1/4 to 1/2 percentage point. If that happens, you might be able to refinance. Understand that prices might go up, or they might stay flat, or they might even decline in the short term. Have a plan that works regardless of what the market does. And if you decide to wait, that's okay too. Keep saving, keep investing, keep building your financial foundation. The right opportunity will present itself. With rates where they are now, the lowest we've seen in over 3 years, and with inventory finally increasing, we're seeing the early signs of a more balanced market. But that doesn't mean you need to act immediately. Whatever you decide, make sure it's a decision based on math and logic and your actual life goals, not fear or pressure or what everyone else is doing. Because at the end of the day, this is your money, your future, and your life. Don't let anyone else make that decision for you. If this video helped you think through whether buying real estate in 2026 makes sense for you, hit that subscribe button and give it a thumbs up. Drop a comment below and let me know. Are you planning to buy this year, or are you waiting? I read every comment, and I'm genuinely curious where everyone's at with this decision. Thanks for watching, and I'll see you in the next one.